Good morning, this is Kim, and I want to go over your practice quiz that I gave you for this week's assignment. So actually, I'm trying to size this a little bit. I don't know if I can. Anyway, first problem over here was list all the ways we make money in stocks, bonds, and cash equivalents. So this is very important. We make money in stocks by, again, that buying at a price and then selling it for a high price, which would be a capital gain. Again, that's selling the difference between the buying price and the selling price of an asset. And also we make money on dividends. If I could type. Okay, we do not make interest on stocks. It's only capital gains and then that dividend payment. Bonds, also capital gain. Remember, bonds are traded just like stocks, so we can buy a bond at any price and then we can sell it. If it's at a higher price, it'll be a capital gain. If it's at a lower price, it will be a capital loss. But primarily, we also make interest, that annual interest rate that's on the face of the bond and paid out in 4 installments over the year. Remember that video we watched, and that interest rate is called the coupon rate. And then finally, cash equivalents, which includes our savings accounts, money market accounts, and CDs, is all interest only. Okay? So those are the ways we make money in those. And again, as an investor, our goal is to make money. Okay, the next question says, which is a better investment for an individual in the 25% tax bracket? Okay, right here, a muni. And we know that munis are federally tax exempt and state tax exempt if we purchase a muni issued in the state where we live. Well, for our purposes, we just need to assume all are in the state we live in. So a couple ways to do this. I'm going to explain them both. So this would be the first way. First way is to use this formula. Step one would be take the number 1, and subtract the decimal version of your tax bracket. So I'll put here tax bracket, and up here the decimal version of 25% would be 0.25. Okay, remember you got to move that decimal over 2 places to the left to convert a percent to a decimal. So 1 minus 0.25 would be 1 minus 0.25, which equals, not 0.25, which equals 0.75. And then step 2 would be to take the muni rate of just leave it as 6%, and divide it by 0.75, or the answer from question 1. So if we do that, if we take 6% and divide it by 0.75, it gives us 8%. And this is the tax adjusted muni. Okay? And then step 3 is we compare. We compare the corporate rate with the tax adjusted muni and select the higher. Okay, so our tax adjusted muni is 8%, which is higher than our corporate rate of 7%. So in this case, our choice would be then to take the muni because its tax adjusted rate is higher than that corporate rate. Okay, the second way is there's a formula in the book, and it's a formula also for tax adjusted, which is similar. Actually, I'm going to tell you another way. Okay, so at 25% tax bracket, we know the corporate is going to be taxed. So a corporate with a 7% coupon, remember 7% of $1,000 is how we calculate that coupon payment. So our payment up here on the corporate is $70. Our payment here on the muni is $60. untaxed. This one is taxed. So we have to multiply this by 0.25%. So 70 times 0.25% is 1750 in tax. So if we really only receive, what? $70, 1750 subtract leaves us with $52.50. So again, do we want $52.50 or $60? Again, both ways give you the same result. So the muni is the better buy. Okay, problem number 3. Here we have certainly one that you're going to have on your quiz, and that is to compare two competing stocks or two competing companies based on the factors we discussed in class. There are two websites you can use. You can use Yahoo Finance or you can use Morningstar, whichever you prefer. So I'm going to have both of them up here and also looking for the information in both. So let's go back to Yahoo Finance, which was in one of the videos for my online class. And the factors I want to look at are these. This is what I've written down. So where do I find revenue growth? Well, I go over here in financials. And then I want to look at right here at the income statement, and I want to look now. Remember, this is 2015, 2016, 2017 in reverse order, but what I really want is a growing company. So if I'm looking at Exxon here, it went from 239 down to 200 and then 237. So it has a very irregular revenue growth. So I'm just going to note that it's irregular, which is not really what I want to see, but there's been several issues happening in the for energy companies, so maybe I'll see the same thing at Chevron. Okay, the next thing, I'm going to go back to just my summary here, and I'm going to see if any of these factors are just available on my summary, because I know that they are. So the first one, here's beta, 0.84. So certainly less risky than the market at 0.84. Next, the PE ratio, 16.23. Can't compare that to anything because I don't have Chevrons. Next is earnings per share, $4.63. And do I have anything? Oh, I have my dividend. So here's my dividend right here, and it is, looks like it's $3 or it's $3.08. Okay, that's the projected dividend for this year. So I have quite a bit of information just looking at the quote page and then looking at the revenue stream. All of my other factors really are going to be either here on historical data, I can look for some patterns, or right here in statistics. Okay, so if I go here, there's my beta again. I'm right on the front, the statistics quote, and I know that from your video, you should know this too. There's my 52-week change. So Exxon has actually dropped in the last 52 weeks, so it's negative 8.52%. Not equals, how about negative 8.52%. And let's see what else. At least it's making money despite the fact that its stock price isn't. There's return on equity at 10.78%. And then I always like to take a look at the company's debt. Let's see what their debt is. So if I look down here, and remember, I can go to the balance sheet to see that total amount of debt. So, and look to cash. So $42 billion in debt and only $3 billion in cash, which means this heavily in debt. Okay. So there we have that, some interesting statistics from Exxon. Okay. So I want to look and see though, because Exxon's an income stock and it's been around for a long time. So I'm kind of curious, and I'm going to look right here at historical prices. So remember, I can go to historical data and I can type in a specific price that I want. But right now, all I want to see are dividends only. So I'm going to click on that, and I want to see. I want to look at a time period that's a little bit larger. So I'm going to look at max right here. I'm going to type in 1970 when it went public till now, and I'm going to hit apply. And what I want to see, or what I expect to see, is growing dividends over time. Has a dividend, because now I'm going back in time, and what I'm really seeing is a pattern of increased dividends over time to where it is right now at $3.08, which is a pretty high dividend. So that looks good to me. Now, is Exxon going to continue paying dividends in the future? Well, probably, because if it didn't, it would send a shock wave through the market, and many people would sell Exxon. So let's go with that, and then now let's go ahead, and I'm going to go over to Morningstar right here, and I have Chevron over here. So again, right from the quote page, I just want to see what I can get from here. PE ratio for Chevron over here is now 24.17. Oops, how about getting in the right box? 24.17. Shift this over a little bit. Okay, so it's higher, and remember I want a low PE. So Chevron is higher right now. I'm moving down just on the main page, and I want to see is there any other information I can just collect by scrolling down here. Chevron's doesn't have, let's look at its 1-year return, which I believe is right below the chart. I'm going to have to expand this out because right now it's truncated a bit. Moving down here, I see revenue. Actually, there's its earnings per share, $4.85. So it's basically comparable to Chevron. I see down here, again, I already have my PE ratio. I'm more interested in return on equity. So for 2017, it wasn't as high. It was 6.26% instead of 10.78. Its current dividend is $4.48, so it's higher than Exxon. And I don't think I have any other information I want here. So remember, Morningstar is a little different, and to get all of our primary information, we're going to have to go back up to the top and click on key ratios right here. And then when we do that, we can get the full key ratios data right there. And this is a very comprehensive sheet. So let's take a look at revenue. This has historical revenue. So remember, Exxon was going down, and it looks like Chevron, I'm going to pop this up. Here's Chevron. So we have it at 138, dropped just like Exxon, but then it's back up higher than 2015. So that's better than Exxon, because Exxon wasn't up to its 2015 levels. So if I go back here, I can just type in here. I'm going to open this up wide, and I'm going to also say irregular, but better than Exxon. Okay, I've already found EPS, PE, and return on equity. Now I'm going to go look at that dividend, and I'm expecting that I'm going to see a dividend over time that has increased. And there's my dividends. So I look here and I see increasing up to $4, up to its new high of 432. So that looks good to me. Here's book value. Book value is pretty solid. I didn't look at the current book value for Exxon, but I could. What else do I want to know? Here's the key ratios for profitability. Again, return on equity kind of been dropping steadily as the energy companies have been hit pretty significantly. If I go look at financial health of the company, click on that tab, financial health, I can look at the long-term debt. And this is as a percent, so kind of difficult to calculate here. But what's been happening to Chevron's long-term debt? It's been going up significantly. Way back 3.56, pretty steady increase, and now actually pretty high. So their debt is growing. Let's see. Anything else I'm interested to on here? I don't think so, but I'm going to pop into my worksheet right here, and I'm going to put that their debt is growing. Okay. Let's pop back in here to my ratios. These are efficiency ratios. And I have some turnover rates which I'm not using in this. I think that's okay. So what am I missing on my sheet here that I want to compare? Beta and total return. All right, so if I go back here, the total return for last year using Morningstar is back on the main page right underneath the price chart. So if I go look at the price chart, the total return even year to date is also negative. And 2016, pretty good year. Last year, also pretty good year. And then now we're negative again. So what is going on with the oil industry that's causing quite a bit of volatility in these markets? I'm going to go back here and I'm going to put a negative 5.57%. I still haven't found beta, so I'm still looking for beta on Morningstar. And it should be under risk. Okay, well, I'm going to cheat. I'm going to pop over here into finance.yahoo and I'm going to type in Chevron, which is CVX. And I know that beta is on the front page. So perhaps it's a good idea. Here's Chevron. I just want the summary page. And I see that the beta, it's not available. Okay, well that's interesting. So we'll leave it as not available. So once you look at these and you say, okay, given that these companies are income stocks, they are paying high dividends and have been paying high dividends forever. Growth, kind of volatile. Remember, they're both up and down. So if you're looking for a growth stock, neither one of these would be highly desirable for you. Also, debt is growing for these companies and they have negative returns year to date. So when I say here which stock represents the best investment and why, remember you have four choices here. You could say both stocks because you want an income stocks perhaps. You could say neither. None of these really excite me and I only want to buy stocks I'm interested in. Or you could say Exxon, or you could say Chevron. Okay, so there's four choices, but really why? So I might say here, this market for oil is very volatile and I can see too much up and down in the market, and I'm looking for a growth stock, not particularly an income stock in the form of dividends. So I'm not interested in either one of them. And that you could type out, and that would be a good assessment of which stocks represents the best investment. Okay, I'm going to move on. You purchased a corporate bond, so now we're back to bonds. It pays 6%. So right here, 6%. Just go in here and put in, it's a $60 payment. Okay? Purchase price was $10.50. Today, comparable bonds are paying 4%. So bond interest rates have gone down. What do you know that happens when interest rates go down? Bond prices go up. So the first question is, what is the annual dollar amount of interest that you receive from your bond? Well, that's par value multiplied by 6% or $60. Remember, par value is always 1,000. Comparable bonds are paying 4%. What is the approximate price for which you could sell your bond? Well, that would be current price. Remember, that equals the coupon payment divided by the current rate. Well, we know that the coupon payment is $60, and we know that the current rate is 4%, 0.04. So if I put that in my calculator, it gives me $1,500 as a current price. Okay, and you have to show the math for these, both online and in class. Okay, question number 5. Sam bought 100 shares of Costco 1 year ago at the closing price. Today he sold the stock at the current market price. He paid a broker $10 when he bought it and when he sold. During the year he owned the stock, he received the annual dividend. Here's how I like to do these. I like to put together all my costs and then all my income. So costs. First, he bought the shares, 100 shares, multiplied by the price a year ago. Pop right back in here. I'm in Yahoo, historical data. Right here, historical data. And then I want the price 1 year ago. So I'm going to switch my time period here, and I'm just going to put it's already 3/12/2017, and I'm going to put 2017 here. Done and apply. It's probably on a Sunday, so there's no price. So we'll just go to the price 1 year ago on, let's try pretty close to that, 3/14 and 3/14. Okay, so the closing price on and around that date was $107. You can take off the cents. This doesn't need to be exact. $107 is good enough. So I'm going to go right here, times 107. Okay, 100 shares times 107 is going to equal $10,700. That was a cost. Also, I had to pay a broker $10 to buy and $10 to sell. So I have another $20 in broker fees. Okay, during the year, you received the posted annual dividend. Okay, I'm going to go back here to my chart. First of all, I left it at Chevron, you guys. I need to change it to, well, I'm going to pretend like I'm doing this for Chevron. So Chevron's current price is $116.67. So this is 116 about. So this is going to be 11,600. when I sold it. And what was the annual dividend for Chevron? There we go. So the annual dividend for Chevron is again right on the summary page. And I should go back and look at a historical dividend. But right now, yeah, I'll do that. I don't want the projected dividend. I want the dividend that was paid last year. So if I go to historical dividends, instead of prices, dividends only, apply. So over the last year, the historical dividend, you can tell all these numbers will be the same. So it was paying $1.08. So if I add that up, this is the new dividend moving forward. So let's say I have $1.08, $1.08, $1.08, and $1.12. So if I add those four together, being over the last year, and that's what I want, I'm going to have $4.36. So I'm going to go back here to my sheet. So I have $4.36. Remember, dividends are paid per share. So I'm going to multiply that times 100 shares, and that equals $436. So that is my cost. That is my income. So now all I need to do is take my income, which is $12,036, and subtract my costs, which is $10,720. And I have $1,316 in income, or dollars. Okay, so I actually did this for Chevron because I forgot to change it to Costco. You will have a problem like this, so make sure you understand how to do this. Okay, why does dollar cost averaging work as an investment strategy? Remember, we pay the same amount each month. So by contributing the same dollar amount each month, or whatever your period is, each month you are forced to buy more when prices are low and less when prices are high, as long as the market continues to grow over time. Your average cost will be lower than your market value. Okay? That's why that works. Now, if our market were to go down over time, we would effectively have the opposite experience. We would lose money using dollar cost average. Okay, why do we care about the indexes, the Dow Jones, the NASDAQ, and the S&P 500? They are our gauge on So they give us an indication on how well our portfolios are doing and also sort of the overall economy. Now, again, a lot of times, at least right now, they're so volatile. They're just telling us that there's a lot at work in the market that really has nothing to do with companies, but has a lot to do with perhaps politics. So, but anyway, they give us a gauge on what's happening in the markets. What are the 5 types of stocks discussed in class? I'm not going to go over these definitions, but I am going to tell you that they are blue chip. Need to know these: income, cyclical, penny, and growth. Understand these and also their risk. What is the most risky? Penny. What's the second most risky? Growth. Third, cyclicals have some level of predictability because they follow along with where we are in the business cycle and in the economy. Income stocks, least amount of risk because they are from companies that are continually paying dividends and that are very, very old. And then blue chip would be next in terms of lowest risk because that you can make money both in growth and in dividends. Primary difference between corporate and government bonds. So corporates are rated, callable, riskier. All right, which means that government are all AAA, if they're federal government, non-callable, and therefore safer. Now, if you decided to compare to munis, then you could talk about the tax implications. And there are tax savings implications for munis. Okay, describe the terms market order, limit order, and stop loss. Market is an order at the current market price. Limit order has some restrictions. Remember, you could say, I will only buy this stock if the price reaches this level. I will only sell this stock if it reaches this level. So you place some limits on it. Okay, a stop loss sounds like this. Says, sell my stock if the price drops to this level. Some downside protection. You can put in a percent or a dollar amount, and let's say you put in 10%. If your stock falls 10% below the purchasing price or the current high price, it'll flip to a market order and sell it. Okay, last question. This is a long video. Buy and hold. What does that mean? It means we buy good companies and we hold on to them for a very long period of time and just have a diversified portfolio and receive the return of the market overall. Okay, direct investment. There are some circumstances where you can buy stock directly from the company. It has some limit, it has some funny rules, so it's not as easy as you think. Dividend reinvestment is just like it sounds. You get paid dividends 4 times a year. So 4 times a year, you purchase more shares of the same investment. Okay, and then dollar cost averaging I explained above. That means you set a particular amount, specific amount invested. That does not change. Okay. So that's a lot. There's a lot to study. I'd listen to the videos again. I think I might just go ahead and post. I'm not going to go over the answers, but I will post another previous quiz. So study. You don't have any homework this Thursday. The test is going to come out tomorrow, and I'm going to close it on Sunday for my online students. Thanks.